2021, the 25 richest Americans paid a true tax rate of 34%. You probably paid more than that, and it's completely legal. Here's how they do it and why you can. Let's start with a story. Meet two people. First, Sarah. She's a nurse, makes $6,800 a year. A year, works overtime, pays her bills, does everything right. Every 2 weeks her paycheck hits her account, and before she even sees it, the government has already taken about 22% in federal income tax, plus another 7.65% for Social Security and Medicare. So out of her 6,800, she's losing nearly 2,000 before she buys a single gallon of gas. Then she pays sales tax, property tax, if she owns a home, gas tax, all the little taxes you don't think about. By the end of the year, Sarah has paid close to 30% of her income in taxes. Now meet Richard. Richard is worth $4.2 billion. He owns a massive stake in a tech company. He lives in a mansion, flies private, sends his kids to schools that cost more than most people's houses. And last year, Richard paid $0 in federal income tax. Not 3%, not 1%, 0. And again, this is completely legal. So what's going on here? Why does Sarah, who can barely afford to max out her 401k, pay 30% while Richard, who could buy her entire neighborhood in cash, pays nothing? The answer comes down to one simple thing most people don't understand. The tax system does not care how much you are worth. It cares how much income you report. And the ultra-wealthy, they have figured out how to live like kings without ever reporting income. Let me show you how. Step 1. They do not take salaries. Sarah gets a W-2A paycheck, taxable income. Richard does not. He might take a symbolic salary, $1 a year like some CEOs do. But his real wealth, it is in stock. He owns shares in his company worth billions. And here's the key. As long as he doesn't sell those shares, he doesn't owe taxes on them. The IRS doesn't tax wealth. It taxes realized gains. So Richard's net worth can go up $500 million in a year. And the IRS says, cool, let us know when you sell. Meanwhile, Sarah's income is taxed the second she earns it. She can defer it, she can avoid it. It's just gone avoided. It's just gone. Step 2. They borrow against their wealth, tax-free. Okay, so if Richard never sells his stock, how does he actually spend money? Does he just sit on a pile of shares and eat ramen? No. He borrows. It's called buy, borrow, die. And it's the cornerstone of how billionaires avoid taxes. Here's how it works. Richard walks into a private bank and says, I own $4 billion in stock. I'd like a $50 million loan. The bank says, no problem. They give him a loan at an interest rate of maybe 2 to 3%, basically nothing, using his stock as collateral. Now Richard has $50 million in cash to spend. And here's the magic. Loans aren't taxable income. The IRS doesn't tax borrowed money because technically you have to pay it back. So Richard buys the mansion, the jet, the art collection. He lives like a billionaire and pays 0 income tax. Meanwhile, Sarah can't do this. She doesn't have billions in stock to borrow against. If she wants $50,000, she has to earn it and pay taxes on every dollar. Step 3. They never sell, so they never pay capital gains. Okay, but what about that loan? Doesn't Richard have to pay it back eventually? Technically, yes. But here's the trick. He just takes out another loan. He uses stock that's grown in value as collateral for a new loan, pays off the old one, and rolls it forward over and over for decades. He never sells, he never realizes a gain. He never triggers a taxable event, and when he dies, his heirs inherit the stock. And here's the kicker. They get something called a step-up in basis. That means the IRS basically resets the cost of the stock to its value at the time of death. So if Richard bought shares for $10 million, and they're now worth $4 billion, his kids inherit them at $4 billion. If they sell the next day, they owe 0 capital gains tax. The gain just disappeared. This is called buy, borrow, die, and it's how generational wealth is preserved completely legally, while paying almost nothing in taxes. Step 4. They donate to charity, and get Richard doing it. Now let's say Richard wants to look good. Maybe he's getting some bad press. Maybe he wants a building named after him. So he donates $100 million to a charity. Sounds generous, right? But here's what actually happens. He doesn't donate cash, he donates stock. Stock he bought for $10 million that's now worth $100 million. He gets to deduct the full $100 million from his taxable income. But he never pays capital gains on the $90 million in profit. And if he's smart, he donates it to a donor-advised fund which he controls. So he gets the tax break today. But the money doesn't have to go to an actual charity for years. He can invest it, grow it, and decide later where it goes. It's a tax-advantaged personal investment account that looks like charity. Sarah, meanwhile, donates $500 to her local food bank and gets a deduction worth maybe 120 cool. Step 5. They live in states with no income tax and move assets offshore. Richard doesn't live in California or New York. He lives in Florida or Texas or Wyoming, states with zero state income tax. And his accountants have set up a web of LLCs, trusts, and offshore entities in places like the Cayman Islands or Delaware. Not to do anything illegal, but to make sure that every dollar is routed through the most tax-efficient structure possible. Sarah can't do this. She lives where her job is. She pays state tax, local tax, property tax on a modest home. She can't hire a team of lawyers to incorporate herself in the Bahamas. So let's recap Sarah. The nurse earns a salary taxed immediately, pays income tax, payroll tax, sales tax, property tax, can't borrow against assets she doesn't have, saves in a 401k that's taxed when she retires, pays roughly 30% of her income in taxes. Richard the billionaire takes no salary, borrows against stock tax-free, never sells so never pays capital gains, donates appreciated stock for huge deductions, dies and passes wealth to heirs with zero tax on gains, pays an effective tax rate of 0 to 3%, and all of this perfectly legal. Now let's be clear, this isn't about demonizing rich people. Some of them are lovely, some donate billions, some create jobs, but this is about understanding the game. Because when people say just work hard and save, they're missing the point. The system isn't designed to reward income. It's designed to reward wealth. And wealth compounds without triggering taxes, if you know how to structure it. Sarah works hard. She's disciplined. She saves, but she's playing a different game with different rules. And nobody told her, the tax code isn't neutral. It's written by people who understand the difference between earning a paycheck and owning assets. And until you understand that difference, you'll keep feeling like you're doing everything right and still losing. So what can you do? You're not going to become a billionaire overnight, but you can start thinking like someone who builds wealth instead of just earning income. Max out retirement accounts that's tax-deferred growth. Invest in index funds. Long-term capital gains are taxed lower than wages. If you own a business, talk to a CPA about structuring it as an S-Corp or LLC. If you own property, learn about depreciation and 1031 exchanges. You're not going to borrow $50 million against stock, but you can stop thinking that a bigger paycheck is the only path to wealth. Because here's the truth. They don't teach you income is taxed. Wealth is protected. And the sooner you shift from one to the other, the sooner you stop funding a system that wasn't built for you. If this opened your eyes, share it. Send it to someone who's tired of feeling broke on a good salary. And if you want more breakdowns like this, the stuff they don't explain in school, hit subscribe. Because we're just getting started.